In the grand dance of central banking, the steps can sometimes seem esoteric, even robotic, a ritual of models, projections, and finely calibrated decisions. But at its core, monetary policy is an intensely human affair, shaped by the psychologies, pressures, and politics of the people formulating it. The European Central Bank is giving us a window into this intricate psychodrama. As the inflationistas who demanded severe interest rate hikes now give way to the growth crowd pleading for respite, we're seeing the ECB struggle to strike a delicate balance between its dueling mandates. In my view, they are reasonable expectations. The Finnish central banker Olli Rehn declared this week, giving an implicit nod to market pricing for 2 more rate cuts this year down to 3.25%, with a long-term terminal rate around 2.25 to 2.5%. With those frank comments, Rehn has emerged as the leading voice arguing that the ECB needs to ease its policy stance to foster the economic revival promised land. His remarks land in a febrile landscape. Across the continent, citizens are feeling the bite of soaring prices and ebbing growth. In France, President Emmanuel Macron's call for snap elections has jangled nerves about political instability, sending modest tremors through bond markets before recent stabilization. Into this breach strides the measured figure of Rehn, with his mellifluous talk of a disinflationary process underway, a gradual recovery starting this year, and the ECB's responsibility to back full employment and balanced growth. His is the fatherly voice of reassurance, coaxing the economy back from the edge without reckless zeal. Yet even as Rehn plays gentle ECB dove, he retains the threat of hawkish talons. Yes, policy must avoid unnecessarily delaying economic healing, he allows. But rates remain quite clearly in the restrictive territory, lest backsliding undo the progress made on inflation. A calibrated yin and yang, forceful moderation. This duality captures the ECB's broader contortions as it seeks to transcend its recent single-minded focus on cooling scorching prices. After dousing the inflationary blaze, it must navigate a new crisis, the risks of overcorrection, of snuffing out too much economic vitality in its zeal. The bank's democratic legitimacy itself may hinge on sustaining domestic prosperity and financial stability. So we have Rehn calmly batting down talk of an imminent debt implosion akin to the maelstrom he confronted as the EU's economic chief a decade ago. Even as France's political fever could conceivably trigger self-fulfilling capital flight, the Finn insists disorderly turbulence is not brewing today. For the ECB, keeping a steadying hand on the economic tiller is paramount. To that end, Rehn also signals tactical flexibility around ECB rate decisions, shunning the quarterly straitjacket preferred by some colleagues. In his vision, each meeting offers a live option to pivot, a fluid cadence as one analyst described. Stay primed to reverse course as the data evolve. It's a reminder that while economists model worst-case scenarios and markets fixate on terminal rates, policy formulation is an intensely human process, a psychological two-step, driven as much by official mindsets as by hard numbers. The pivot underway at the ECB towers reflects that deeper reality. Bloodless charts belie the heavy brew of confidence, doubt, ideology, and political cues stirring behind the curtain. Policy responses both shape and get shaped by the all-too-human swirl of sentiment and vantage points in the halls of power. In 2008, just after the financial crisis erupted, I sat in the Federal Reserve's boardroom as officials strained to decode the latest flickering data points. "We need to get the economy out of this death spiral," one senior staffer intoned with urgency. Their words underscored that even pinnacle technocrats harbor hunches, attachments, and fears that color the most ostensibly objective decisions. The ECB's Rehn seems to grasp this complexity well. His language marries the Delphic lingo of econospeak with more grounded appeals to collective economic and social welfare. Even as the bank pivots to a new policy stance, he projects a steadying constancy of purpose, guiding Europe between the Scylla of too-hot inflation and the Charybdis of too-cold demand. Ultimately, successful central banking requires not just analytical rigor but a more transcendent policy wisdom. Monitoring incoming data in real time, intuiting how the economy's human coordinates are shifting, calibrating responses to restore confidence and nurture resilient growth. This subtle alchemy is now playing out in Frankfurt's marble halls. Rehn's comments remind us that, for all the equations and models, monetary policy remains an inherently political undertaking, an arena where human biases, power struggles, and social undercurrents shape the machine's every pivot and lurch. By striving to read those deeper currents and restore balance, The maestros hope their grand dance can summon an economic spring.